if we think the value is there, and again, just getting back to the margin of safety issue, we owned AIG, American International Group, back in the early 2000s, and we were lucky to remove it from our portfolio when it got very complicated and we couldn't understand it. We own it now. It is a much simpler business. When you look at their main businesses, SunAmerica and Chartis, their insurance operations are actually very solid, very stable. They're going to be able to continue to grow. They're looking to expand worldwide. They announced today that they were going to continue to buy more shares back from the government. I think it's a very misunderstood asset because, again, your business partner is the U.S. government. You never expect them to make logical decisions. So the federal government owns 70% of the business, and you never know when they're just going to dump their shares on the market. Fortunately, AIG is producing enough free cash flow internally to where all the shares that the government has sold, they've been able to pony up and buy a significant portion of them. You've also got a hidden asset. So this is about a $58 billion market cap company. And if you just look at their PE ratio, it's in the 20s. It doesn't make sense. But if you actually look at the free cash flow, it's very deceptive. The free cash flow yield, as far as we see, is probably north of 20%. And it's because there's a hidden asset that's buried deep within the footnotes that to a taxable investor is very meaningful. And that is that they've got about $23 billion worth of tax loss carry forwards, and then they've got another $4 or $5 billion worth of tax credits from foreign taxes paid. So, you know, if you're in the 35% tax bracket, you're looking at somewhere around $12 billion worth of assets that aren't even reflected anywhere on the balance sheet. It's just a footnote. In our opinion, as the business continues to roll forward, every day they make a little bit more progress, they're not going to pay any taxes for a very long period of time. The free cash flow from that business is going to be very handsome, which will allow them to either make strategic acquisitions, increase the dividend, or buy back shares. So that's one that, in our opinion, is very misunderstood. It's kind of exciting. A lot of our clients really don't understand why we would put it in their portfolio, but that's a perfect example of something that we think is mispriced, mainly because it's misunderstood.
What do you think is then the main risk to your investment case with AIG?
I guess the government could always do something dumb, but I think it's more likely that the government is going to want to just get their money back. Bob Ben-Moshe, the CEO, he has said, not only do we plan on paying the government back everything, we actually think they're going to make a very handsome profit off of it. So if AIG is profitable with the CEO that they have faith in, I see them as being willing business partners, maybe not happy business partners, but willing. And so I think the government actually can be an ally if we have another really bad 2008 type event. Actually, I think the government will be a backstop, whether they want to be. I mean, they're not going to unload 70% of the market share in the next year or two anyway. You know, and the other thing too is that insurance is a tough market. Sometimes you have soft markets and sometimes you have hard markets, and sometimes people bid stuff at ridiculously stupid prices, and it can cause the profitability of insurance to be depressed for considerable periods of time.
And have